on and talk about an interesting article that we read earlier in the Economic Times about arbitrage funds perhaps not finding enough investment opportunities. In fact, the CT article also mentions that some mutual funds have already asked their unit holders to brace themselves for tough times. But let's get clarity on that point directly from none other than Radhika Gupta herself of Edelweiss AMC. Radhika, thank you so much for joining us today on ET Now. It's a pleasure having you with us. Let's talk about this category of arbitrage schemes. Now, there's a CTA article that's saying that maybe arbitrage schemes are not able to find enough investment opportunities because of spreads dipping into negative territory. Now, for your retail investor, things like stock futures, trading above cash market, etc., could turn out to be a little complex. And Radhika, I guess you're great at breaking down such simple terms. So why don't you just clarify on this entire point?
Thanks, Mubina, for having me and, for discussing an important category here. I think, if I had to be very honest, I've read the ET article, I've read the Mint article, there's been a lot of articles about this space. I think we're overcomplicating and overanalyzing what, as you said, should be a very simple category for investors, for the retail investor, and maybe I want to share some light on it. Now, we have been very old players in the arbitrage space as Edelweiss, and if you look at what our funds are meant to do, they are meant to give you better post-tax returns than liquid funds or debt funds with a 3 to 6 month time horizon. And I'm going to re-emphasize that 3 to 6 month time horizon. They are not meant to give you 15-day or monthly returns. They do this by they do this through two ways. They give you these better post-tax returns in two ways. One is they participate in arbitrage opportunities in the equity market. So if I'm buying Reliance, for example, I'll sell equal amounts of Reliance and there will be an arbitrage spread that I will capture and I will get some benefit. I'll also put some money in high quality fixed income. So that's what the fund does, and it enjoys the benefit of equity taxation. If you see what has happened on a 3-month basis, and I was actually pulling up some numbers before the show, and this is in our note, the minimum return since 2014 in an ARB fund is 5.3%, and the average return over a rolling 3-month period is somewhere like 6.5%. So if you are a retail investor holding for 3 to 6 months, do you have anything to think about? I don't think so. The last month, which has attracted a lot of news and attention, has been an exceptionally volatile month in terms of arbitrage spreads. Also, remember, a lot of money has come into this category. Now, what has happened in terms of spreads coming down for 1 month is actually not exceptional. It happened many, many times over the last 5 years. In fact, in 12 months of running this category every year, probably 2-3 months, this happens. But it smoothens out over a 3-month period. And in fact, our note in the ET article referred to the note was never meant to scare investors. We publish a note at the end of every month for institutional investors largely. It was just to tell them that, hey, spreads might be lower this month. Don't panic too much. If you're a 3 to 6 month investor, which you should have been, then there is nothing to worry about. So there was no alarm bell that was rung about the arbitrage category. But because a lot of money has come into this category over the last 2 months because of what's happening in the debt mutual fund market, I think the category is attracting a lot of attention, which is why, comments like these.
Radhika, it was very important to get that clarification, and I'm so glad you've done that for all of our unit holders. Radhika, how exactly would you position an arbitrage fund in a retail investor's portfolio? You mentioned that the aim is to essentially give a bit better returns than what a liquid fund does, which maybe is 4-5 odd %. And you're saying that it has to be for 3 to 6 months. So you can understand that it's a short-term investment instrument. So what should be, how much rather should maybe a long-term retail investor put in an arbitrage fund? What category would it fall under? I mean, is it something that could be used simply as, an instrument where you can park your money instead of putting it in a savings account to earn a rate of return that's better than savings account or liquid fund?
So I would answer this in 3 categories. I think for a retail investor, and debt is a very complicated space with 16 categories of mutual funds, I think debt has 3 buckets, and I'll tell you where arbitrage falls. there is money less than 3 months for which arbitrage is not appropriate, please use a liquid or overnight fund. And I correct myself if I said liquid, I meant liquid plus kind of stuff. So for less than 3 months, please stick to liquid and overnight. For any money between 3 months to 3 years, I think arbitrage is perfect parking money. It makes a lot of sense in 3 months to 1 year because it attracts 15% rate of taxation. In the 1 year to 3 year bucket, it attracts long-term capital gains taxation if you do the growth option. So then you get 10% rate of taxation. So that actually becomes superb. So if you're looking to park money even for a year, I use arbitrage funds personally. I mean, this is how I invest personally. Over 3 years, sometimes debt funds on a post-tax basis may look comparable as efficient. But in that 3 month to 3 year bucket, arbitrage funds look super. In fact, I'll give you a statistic from our own funds. The average holding period for a retail investor in an arbitrage fund for us has been 9 months. So that's the kind of holding period people have. And over that holding period, as I said, the worst case return has been 5%. The average has been 6%. The best has been 8%, something like that.
All right. Again, another very important clarification from Radhika Gupta coming in. Folks, you don't have to worry as such when it comes to arbitrage funds. Just ensure that you have 3 to 6 months in mind before you put your money in an arbitrage fund. Radhika, really appreciate you joining us. Thank you so much, for giving this very important clarification to all our viewers. Like you mentioned, flows as well have been coming into these funds quite rapidly, and that's why it's garnering a lot of attention. We'll wrap it up on The Money Show. Many thanks for watching.